The stock market has had a strong run. Nobody is arguing with that. But here is something worth thinking about. When one part of the market has already run hard, the best opportunities are often somewhere else, in the corners that have not been discovered yet, in assets aligned with where the world is actually going right now, not where it already went. In 2026, there are 5 specific asset categories that are drawing serious attention from investors who understand the current economic environment, not because they are guaranteed to outperform, but because the forces driving them are real, structural, and unlikely to reverse. This video breaks down what they are, why they are relevant right now specifically, and how someone with a modest amount of money can actually access them. Let me tell you about Nina. Nina is 29. She has been doing everything right, or at least everything she was told was right. She has a TFSA. She puts money into a broad market index fund every month. She has been doing it for 2 years. She is proud of it, and she should be. But lately, she has been watching the economic environment with a growing sense of curiosity. Volatility, geopolitical uncertainty, trade tensions reshaping global supply chains, tech sector corrections sitting alongside AI-driven surges, inflation that came down in many countries but left prices structurally higher, interest rates that stayed elevated longer than most forecasters predicted. Her index fund is performing, but she is starting to wonder whether she is missing context, whether there are legitimate asset categories she has not considered, whether the current economy has created openings that look different from the ones available 5 years ago. The answer is yes. And the question Nina is asking is one of the smartest questions a 29-year-old investor can ask. Before we get into the 5 assets, you need to understand why this specific economic moment is creating these specific opportunities. We are living through a structural economic transition, not just a cycle. Supply chains that were global for 30 years are being regionalized. Governments are investing heavily in domestic production of critical goods: energy, semiconductors, food security, defense infrastructure. Significant capital is moving into new places. AI is restructuring the value of different types of work and the profitability of different industries at a pace that is genuinely unprecedented. Interest rates, while beginning to ease in some countries in 2025 and 2026, remain meaningfully above the near zero environment of 2009 to 2022. This changes which assets generate income and which ones merely speculate on future growth. And an entire generation has been largely priced out of traditional property-based wealth building in many major cities. They are finding and creating alternative asset markets. These conditions do not make broad stock market investing obsolete. Low-cost index investing over the long term remains one of the most reliable strategies for most people. But they do highlight specific asset categories that are positioned differently. Assets whose performance is driven by forces that are somewhat independent of traditional equity market cycles. These are 5 of them, with honest context on each. Asset 1. Private credit and income lending platforms. Here is the simple version. When central banks raised interest rates aggressively between 2022 and 2024, traditional banks tightened their lending to small and medium businesses. Businesses that needed capital faced higher barriers from traditional sources. Private lending platforms stepped in, and they charge higher interest rates to compensate for the additional risk. Platforms now exist in North America, Europe, Australia, and parts of Asia and Africa that allow individual investors to participate in this lending. You act as a partial lender to vetted businesses or individuals. They pay interest. You receive a portion of it. Advertised gross yields on established platforms have reached 9 to 14% in some cases. However, and this is important, actual investor returns, after accounting for defaults, fees, and platform risk, typically land in the 5 to 10% range depending on the platform and the period. This is not a guaranteed return. Lending carries real default risk, Unlike stocks, if a borrower defaults, there is no market to sell into. Diversifying across many loans on a single platform is the primary risk management tool available. For someone comfortable with that risk profile and looking for income generating assets, this category is worth researching. But go in with realistic expectations and only with money you can afford to have locked up for the loan period. Platforms to research, depending on your country: Lending Loop in Canada, Funding Circle in the UK, Plenti in Australia. Always verify current platform regulation, track record, and default rates before committing any money. Asset 2: inflation linked government bonds. This one sounds boring. It becomes interesting when you understand what it actually does. Inflation linked bonds, called RRBs in Canada, TIPs in the US, index linked Gilts in the UK, and equivalents in most developed economies, are government bonds where both your principal and interest payments adjust with official inflation measures. When inflation runs at 3%, your bond's value adjusts to include that 3% on top of the base yield. Your purchasing power is protected in a way that regular savings accounts may not be during sustained inflationary periods. Important nuance: these bonds can lose value in the short term as interest rates move. They are not without risk or volatility. Their value is most clearly demonstrated over time as a purchasing power protection tool rather than a growth vehicle. In an environment where inflation has structurally reset the cost of living upward in many countries and may remain stickier than central banks prefer, these bonds serve a specific protective function in a portfolio that most individual investors never consider. You can access them through government bond platforms directly or through inflation linked ETFs available on most major brokerages globally. Asset 3: specific commodity segments, energy transition minerals. Commodities as a broad category delivered mixed results relative to equities in 2024 and 2025. The broad commodity indexes did not consistently outperform. That needs to be said clearly. But within commodities, certain segments driven by structural demand shifts showed notable strength. Specifically, energy transition minerals, copper, uranium, and select rare earth elements required for electric vehicles, battery storage, and renewable energy infrastructure. These are not driven by short term market sentiment, they are driven by physical reality. The energy transition requires these materials in quantities that current production is challenged to meet. Multiple governments have designated them as critical to national security. Investment in mining and processing capacity is a multi-year build. The opportunity here is not speculative trading. It is long-term exposure to demand that is policy mandated and infrastructure backed across dozens of economies simultaneously. Critical minerals, ETFs, and uranium-focused ETFs, available on most major brokerages globally, provide access without requiring you to buy physical commodities. Understand that individual commodity segments can be volatile. Position sizing matters. This is appropriate as a small portion of a diversified portfolio, not a concentrated bet. Asset 4: skill-based digital assets and online businesses. This is the most unconventional one on the list, and the most accessible to someone willing to invest time alongside money. The world has repriced the value of digital systems that generate income without requiring your direct ongoing time after the initial build. An online course on a subject you genuinely know well, a newsletter with a paid subscription tier, a template or resource library, a small software tool solving a specific problem. Digital products sold through platforms like Gumroad, Teachable, or Etsy's digital marketplace. These are assets. They have real valuations. A digital product generating $300 per month in consistent profit, depending on stability, platform risk, traffic source, and niche, is typically valued at 30 to 60 times monthly profit in online business marketplaces. That puts a rough value of $9,000 to $18,000 on something that may have cost a few $100s and several months of evenings to build. The return profile on well-executed digital assets in the right niche is genuinely difficult to replicate through traditional financial instruments, but it requires honest self-assessment, genuine expertise worth sharing, consistent build effort, and realistic expectations about the time before income becomes meaningful. This is not for everyone. For the right person with the right knowledge, it is one of the most compelling capital allocation opportunities available in the current economy. Asset 5. Infrastructure assets through ETFs. Governments across North America, Europe, Southeast Asia, and parts of Africa are committing significant multi-year spending to physical infrastructure. Electricity grids, data centers, water systems, renewable energy installations, fiber networks, ports. This capital flows through companies that build, own, and operate these physical assets. Many of those companies are publicly traded, accessible through infrastructure-focused REITs and ETFs available on most major brokerages globally. Some infrastructure funds delivered strong returns in 2024 and into 2025, and often with relatively stable income compared to broader equity indices. However, performance varied meaningfully across markets and fund types. Infrastructure ETFs are still equity-based. They carry market risk and can be volatile. Consistent double-digit returns are not guaranteed and were not universal across the category. What infrastructure assets do offer, and this is the genuine value proposition, is income generation tied to physical assets with pricing power. Toll roads, energy transmission, data center capacity, water utilities, these charge fees for use that can often be adjusted with inflation. That income profile is different from a growth stock and valuable in a specific way during the current economic environment. The iShares Global Infrastructure, ETF, Brookfield Infrastructure-related products, and regional infrastructure ETFs provide accessible entry points globally. Back to Nina. She does not abandon her index fund. That stays. It is her long-term core, and it has earned its place. But she becomes more intentional about diversification. She takes a portion of her monthly investment budget, not more than 20%, and begins researching 2 of these 5 categories. An inflation-linked bond ETF for purchasing power protection, a global infrastructure ETF for income exposure tied to policy-backed spending. She is not chasing returns. She is not making concentrated bets. She is adding assets whose performance drivers are partially independent of the forces driving her equity index fund. Some protection if equities have a difficult year. Some income from assets aligned with where significant capital is flowing. Over time, her portfolio becomes more resilient, not just more aggressive. She did not take more risk. She took more thoughtful risk, positioned across multiple economic forces rather than concentrated in one. That is what genuine diversification looks like. Here is the reframe. Diversification does not mean owning different stocks. It means owning assets whose returns are driven by different forces. Assets that do not all weaken under the same conditions. The stock market, your employment income, and property in the same city are all partly driven by the same underlying economic forces. When those forces weaken, everything weakens simultaneously. The 5 asset categories we discussed today are driven by lending demand, inflation dynamics, physical resource constraints, knowledge economy shifts, and infrastructure policy commitments. Some of those forces are strengthened by the exact conditions that stress traditional equity markets. In certain segments and at certain times, these assets have shown resilience or strong returns when the broader market environment has been uncertain. The key phrase there is certain segments and certain times. No asset class guarantees outperformance. No diversification strategy eliminates risk, but understanding what your options are and aligning a portion of your portfolio with the forces actually shaping the 2026 economy is better than pretending the only choice is stocks or cash. The most important thing I want you to take from this video is not a list of 5 assets. It is a way of asking questions. Given where the world is right now, what forces are genuinely reshaping the economy? Where is significant capital actually flowing? What problems are so structural and so large that the solutions are likely to generate returns for years, not months? In 2026, those forces are reshaping energy systems, supply chains, the cost of capital, and the infrastructure of the digital and physical world. The 5 assets we discussed today sit in the path of some of those forces. Do your own research on each one. Understand the risk clearly before the rewards. Start small if you start at all. Keep your core, your index fund, your emergency buffer, your long-term discipline intact. And then ask whether a small, thoughtful allocation to something aligned with where the world is going might make your overall portfolio more resilient than it is today. Nina asked that question at 29. It did not make her portfolio exciting, it made it smarter. You now have enough to ask the same question with real context behind it. Drop a comment below and tell me, which of these 5 interests you most? And where in the world are you watching from? Accessibility varies significantly by country, and I want to give you specific guidance on what is actually available from where you are. Tell me your location and which asset caught your attention. If this reframed how you think about diversification beyond just owning different stocks, share it with someone who is building their portfolio and only thinking about equities. Subscribe to Nuella Invests. Every week, we have the honest money conversation, not the one that tells you what you want to hear, the one that gives you what you actually need. See you in the next one.